So Bitcoin could find its way to central bank reserves as soon as 2030. This comes from a new report out of Deutsche Bank, Germany's largest bank, and it outlines how Bitcoin's price has exploded this year, all while gold has ripped to above $4,000 an ounce, and it is not a coincidence. Deutsche Bank thinks that both assets are reacting to these same macro forces: a weakening dollar, geopolitical instability, and a loss of confidence in fiat credit systems. The dollar's share of global reserves has fallen from 60% in 2000 to just 41% today, while gold's share has climbed to record highs, as you can see on this chart right here. Central banks hold roughly 36,000 tons of gold, worth over $4.6 trillion. And for the first time in decades, the gold stockpile is growing, not shrinking, not only in absolute terms, but relative to sovereign debt from the United States. Now, Deutsche Bank says Bitcoin could soon join it. And here's why. Deutsche Bank's research shows that when you overlay gold's historical trajectory with Bitcoin's, adjusting for time and scale, the pattern is uncanny. Gold's early decades were marked by wild volatility, speculative booms, and government hostility. Then, as it matured, its volatility collapsed and it decoupled from short-term risk cycles to become the cornerstone of global reserves. Does that sound familiar? Bitcoin's doing the exact same thing right now. Its 90-day volatility is down to 26%, which is near record lows even as price hits new highs, and Bitcoin is a $2.5 trillion asset now. That's precisely what happened to gold in the late 1970s and the early 2000s. Volatility fell as price rose, signaling a transition from speculative instrument to reserve-grade asset. And Bitcoin's correlation to gold has turned structurally positive. When you lag Bitcoin's performance by 100 days to account for its smaller market size, the gold to Bitcoin correlation has remained positive for the longest sustained stretch ever, beginning back in January when the dollar started weakening, which suggests that the market treats them as part of the same trade. They move together because investors are using both to hedge the same risk, the slow erosion of fiat credibility. Deutsche Bank's framework for what would make Bitcoin a credible reserve asset is already unfolding in real time. Number one, deepening liquidity. Spot ETFs have created an institutional-grade trading base. Bitcoin's market cap now exceeds $2.4 trillion, with daily transactions averaging 444,000. That's the liquidity foundation that central banks require. Number two is regulatory momentum. The SEC's 2024 ETF approval was a turning point. It signaled legal acceptance of Bitcoin as an inevitable, auditable, and custody-ready asset. Regulation is converging towards standardization rather than prohibition. Number three is volatility normalization. The price to volatility decoupling proves maturation, and Bitcoin's volatility is stabilizing even at six-figure prices, just as gold's did in the 1980s. And four is policy legitimacy. Governments already hold it. Deutsche Bank estimates that 517,296 BTC, about 2.46 of total supply, is held by sovereigns, which is led by the United States. That's $65 billion in sovereign ownership before a single central bank officially calls it reserves. The conclusion of Deutsche Bank's paper is blunt. The case for Bitcoin as a strategic reserve asset is strengthening. They see Bitcoin and gold as complementary diversifiers, each scarce, low correlation, and inflation hedging with growing legitimacy. Bitcoin's volatility is fading, its liquidity is deepening, and crucially, the dollar's dominance is eroding. Even a modest 1% reserve reallocation toward Bitcoin across roughly $14 trillion in global reserves would create $140 billion in demand. That's multiple years of ETF inflows compressed into a policy shift. If Bitcoin simply mirrors 5% of gold's current value, that's $230 billion of incremental buying, equivalent to 1.8 million BTC at current prices, or roughly 9% of total supply. That level of sovereign participation would permanently reprice the asset. So what does it mean? It means the safe haven baton is being passed, not replaced. Gold and Bitcoin are not rivals, they are teammates in the same portfolio, with one being analog scarcity and the other being digital scarcity. As Deutsche Bank puts it, this time is not different. Bitcoin is following gold's script step for step, from speculation to legitimacy to institutional adoption to direct integration into traditional finance. The only question is timing. If the dollar keeps weakening and volatility keeps falling, Bitcoin's inclusion on central bank balance sheets by 2030 seems like a reasonable target. And if you believe that's the direction we're heading, position yourself accordingly. Own the scarce asset before the sovereigns do. And if you're a homeowner, you can start doing that today. Horizon lets you unlock a portion of your home equity without debt, interest, or monthly payments to stack Bitcoin. Thank you so much for watching. If you enjoyed, make sure to like and repost so more people could see this. And of course, check out Horizon at joinhorizon.com or by scanning the QR code right there. That's all for today's video. Thanks again for watching. I'll talk to you soon.